Hello, and welcome to the July 2025 version of our economic update that we do monthly here from Kingdom Focus Financial. And we have with us today Chuck Etzweiler, Michael Smith, and myself, Derek Malden. Take it away.
Thanks, Derek. And wow, we're halfway through the year, everybody. Can you believe it? If you've walked outside recently, you know that summer is here for sure. But we have a lot packed into today, so I want to jump right in. A lot has happened this past month in June. You probably really like your account statements that you got in the mail, but might be worried about what's going on in the world. And so we're going to deviate this month from our power theme, take a little break from that, and we're going to specifically talk through some of the events that are happening in the Middle East. I know that many of you, as you've called into our office, this is something that's been on your mind. And while it has some concerns for just life and humanity in general, I want to break it down from a market perspective. And that's our goal today, is to maybe put that out to pasture where it belongs when we're talking about worrying or thinking about your investments. Because in the long run, it's not anything new, right? The world is in constant turmoil, and we're going to share some statistics about what the past has told us happens, and also what we anticipate seeing in the future. And what I do know is all parties, except one, are talking about wanting peace, and the markets do love peace, right? They love prosperity and growth when things are working well. And if we get to that point, we'll see. I think the lid's off to where we may go. But Chuck, I know you've put some thoughts together this month related to conflicts and wars, and I'm anxious to hear what you have to say.
Michael, thank you so much for having me once again. And I think you nailed it on the intro, that we have to view this from a monetary perspective, from a markets perspective. And let us not forget that anytime there's conflict, there's loss of life. And we'd be remiss if we didn't say that was the most important thing. But our clients pay us to actually sift through historical precedents. And that's what I think this is going to be about, as we spend the next 10 to 15 minutes talking about this conflict. So when this military intervention between Israel and Iran and the United States involvement, what was the risk from a standpoint of the markets? It was that oil was going to significantly rise in price. Prior to this, we had oil in the low 60s. Immediately, it moved up into the mid 70s, and the thought was, oh my goodness, it could go to 80, 90, and ultimately $100 a barrel. Thank goodness cooler heads prevail. But how did we actually assess this? So, number one, when you think of Iran, you think of the world's number 5 producer of oil based on volume. Pretty significant, right? Mm-hmm. But if you actually look at the top 10 oil exporters, they're not in that list. And the reason they're not is due to the U.S. and the EU nuclear sanctions, which limits their ability to export oil. They actually have their number one customer, which is China, has about a 15% reliance on Iran's oil. So what was the risk here, Michael? I think the risk was that the Strait of Hormuz, which is an incredible piece of land that juts out into the Persian Gulf. Actually, if you look at a map, you can see that the distance between the tip of the peninsula and actually the country of Iran is about 21 miles at its shortest distance. Believe it or not, 20% of global oil flows through that. So when you think about what was the number one risk here, it was that Iran somehow was going to be able to blockade ships going to and from various countries that are in the Persian Gulf that are exporting oil. If you actually looked at what happened, that was the immediate reaction. We've talked about this before, Michael, that when conflicts happen, right, the market drops like an elevator, but it works itself back up like an escalator. So, of course, it priced in the worst case scenario, which was Iran was going to blockade or cut off the Strait of Hormuz. They don't have control over that from a legal standpoint, but certainly since they're the country that borders it, they would have the ability through many military actions to take that hold of that particular thought process. When you see what actually happened in other events, and we've done some historical work on this, you can go back and look at other time frames when we've seen supply shocks to crude oil, and oil increases anywhere between 5 to 10%. And that's immediately what we saw with this interaction.
Chuck, I think, what's interesting there is you look at history and a lot of these major events, and the generation that remember the last real major oil crisis is mostly retired now. And as I talk with a lot of our younger clients, they don't remember the 70s, right? In terms of what oil prices did to gas prices as a result, and what that meant as from a consumer economy standpoint. But I don't think we're in danger of going back to that. But it is interesting that it's missing in the knowledge bank of many of our clients of what's there. And I also think we're not hearing in the media an important fact that slide shows, and that is America is one of the biggest producers of oil. And it sounds, if you just listen to the sound bites that certain media outlets want to put on there, that we are dependent on the world and we're, cutting off our nose to spite our face. And that's not necessarily true. In fact, the world relies on the U.S. in a lot of categories. And we have to keep that in mind. We are the powerhouse engine. And from the standpoint of the overall markets, conflicts in the Middle East probably have a less of an interruption on things here than what you might hear. Am I right on that?
When you look at the raw numbers, we produce about 13 million barrels per day of crude oil. We use about 22. Part of the reason there's an imbalance there is because some of the distillates that actually are used to create product that take oil into consideration, we don't have under the earth in the United States, and we have to get that from other parts around the globe, and it'll probably always be that way. Yeah. But we're in the path to self-sufficiency. You got it, Michael. And I think sometimes that's lost in the shuffle here. The news doesn't report that, unfortunately.
Got it.
Yeah.
But there's other concerns as well. So let's keep going.
Yeah.
Got a lot to pack in.
Yeah, we do. What I'd like to do maybe is shift to talking about how we approach this. I think that's key. And as you said up front, boy, a lot of things have happened within the span of 2 weeks, right? There was a conflict between certainly Iran and Israel. Maybe it'll be known as the 12-Day War. We'll have to see how historians look at this. Our involvement in it was swift, right? And it basically lasted a weekend, 36 hours. But on that Saturday, as you know, our investment committee gets together and we kind of went through several scenarios of what could happen. And we assign probabilities to these type of events. So what's the likelihood of 3 scenarios? And by far and away, I think the number one scenario when we talked about it was this crisis was going to de-escalate. When you think of Iran's best interest is not to have that Strait of Hormuz closed. They're shipping oil to China. It was not in China's best interest to have the Strait of Hormuz closed. And certainly it was in the United States' best interest to have Iran and Israel forge some type of ceasefire. So when you put all that together, we called it the fizzle, which was basically a 70% likelihood that this was going to be somehow cooler heads would prevail and we were not going to see oil spike in price. Of course, there was other scenarios that could have happened. Israel could have continued to strike Iran, and they actually could have gone after their energy infrastructure, which, by the way, they never did. And that was another telltale sign that Israel was holding back. They did not want to create an environment where they were going to take out Iran's export-oriented energy infrastructure. Oil probably would have spiked to $90 a barrel. And that was a low likelihood, but potentially could have happened. And the one, Michael, that was really down on the list was Iran starts to target the Strait of Hormuz. Basically, they begin taking out their neighboring countries, such as Iraq, their ability to export oil, and oil goes above $100 a barrel, and we have this significant risk to the global markets. Thank goodness scenarios 2 and 3 didn't happen, and that the likelihood, again, of this being something in the past, I think, is relatively high as we sit here, and thank goodness for that. Another thing that we did, Michael, and we can probably finish the last part of this, is history plays a huge role in conflicts like this. And as you stated up front, the media loves to stir the pot. They gain viewership by making comments that are much more bombastic. They don't lay out cogent scenarios like this. They just show us the blood in the streets. And if you don't understand history, what in essence happens is you make knee-jerk emotional reactions. So we have a couple of neat charts on this. We've gone back in time, actually all the way, Michael, to the Pearl Harbor attacks back 1941. And we looked at various military interactions where the U.S. was involved. So 10 of these are really all the way up to the intervention in Libya back in 2011. And what we found was quite striking. The markets, which, think of what they are, right? They're the collective minds of tens of millions of people. They tend to sniff out these events, number one, before they happen. And number two, they price in the worst case scenario. So the worst case scenario, again, is what we just laid out, right? That Israel was going to attack Iran's infrastructure. Iran was going to retaliate and to its neighboring countries, take out their infrastructure, and oil was going to go from 60 to 100 literally within 4 or 5 days. That didn't happen, but oil was on its way to doing that if, in fact, there was no resolution. So if you go back and you look at all of these, whether it's Pearl Harbor, the Bay of Pigs, Gulf War number 1 back in 1991, Afghanistan, you'll see that going out over 125 trading days, which is roughly half a year, that there's only 2 post periods of the event happening where there's been a negative return in the equity markets. That was Pearl Harbor and Libya, and that was benign. It was negative 5.6 for Pearl Harbor, negative 6.3 for Libya. So what we see here is a fascination that I think that the media doesn't purport, and that we actually need to, as prudent investment managers and fiduciaries of our clients' dollars, bring to fruition. I think, Michael, we could probably end on what I think is a really good slide, a slide that paints 1,000 words, if you will. And it's always good to have that mental picture. If you look at a line chart, or line graph, I should say, and you take that previous set of data and you go back 65 days, and then you plot out all the way 250 days after the event. So what are these events again? These are the top 10 U.S. military actions, literally going back to Pearl Harbor. You can see that we have a red line in the middle. The red line is the event. What do you see? You see, again, the markets kind of selling off. And that would be expected. Again, pricing in the worst case scenario. But when the worst case scenario doesn't happen, think of going back to Pearl Harbor when we had an attack on what was U.S. soil. Yes, Hawaii was a territory of the United States. But what the worst case scenario was going into early 1942 was that the war was going to make its way to the mainland U.S. As of May of that year, 1942, we realized the markets it wasn't going to happen. The stock market rose 85% over the next 2 years while we were at war, because the worst case scenario didn't happen. You can see in all of these events, actually going out a full year trading, that the markets tend to rise on average. And hopefully, Michael, we can put a bow around this event, and that it'll be looked back at another one in history. But I think, again, if you're not a purveyor of history, you're doomed to repeat some of the things that people do, and that's sell in the middle of an emotional event.
I think an important thing here, too, is that whether it's this or any other event, it's usually more about, is this better or worse than expectations? And that's what you're getting at.
Exactly.
Here. It's not whether it's good or bad. Is it better or worse than expectations? And that happens all the time in the media, in reporting, etc., except that they don't talk about that piece. They talk about whether it's good or bad, not whether it's better or worse.
Derek, that was huge to add that. That's the most important piece. Thank you for that. That's what wraps the bow around this. It's the level of expectations. Thank you for that. Well said.
Yeah, it's almost like we're constantly competing. against the media, right? They want to hype things up and stir the pot, and the water is boiling. And here we are again saying, if the water is boiling, it's because it's hot outside, right? And so find a pool, a way to cool off. But the reality of it is the market usually takes these in stride. And while we may get a little disruption in the long-term picture, I think we're still on track for what we anticipated for this year. I don't see this as a major diversion in overall strategy. And once again, I'm going to say, I think we're in a spot where we should look ahead to the summer and enjoy time with family. There is nothing new under the sun. It's a new name, a new country, a new conflict, but we have been through dozens of these in history. And I think the path that the market has carved out is the path we're going to follow again here in doing that. So once again, thanks everybody for listening this month. I know we threw a lot of data at you, hopefully to help you digest what's going on. But I really do think the major word of caution that needs to be said is that we're entering third quarter. Remember, third quarter tends to be the quarter of the year that's not the greatest. It doesn't mean it's down. It just means if you rank 1 through 4, Q3 is usually number 4. So I don't have a lot of expectations of great things, but it would be great if we got a little bump. But I think it's time to pause looking at your accounts every day, get out, enjoy some sun, make some memories, and we're on pace to continue with what we expect to be a pretty normal, positive year overall in doing that. As always, if you have questions about your particular accounts, feel free to give us a call at the office. And if you haven't done it yet, hit that subscribe button at the bottom so that you get notifications when we put future information podcasts out there for you. Thank you for the trust and confidence you have in us and our team. Thanks, Derek and Chuck, for being here again this week. And
pleasure, Michael.
We look forward to seeing you again next time. Thanks. Have a great day.